Good morning. Once again, we are back, the BI 2.0, and we're presenting on behalf of the Strategic Advisory Team for Prada Group. So for this section, we'll be discussing the external analysis of the Prada Group. So let's start. So in this section, in the external analysis, we'll be discussing the rival analysis and the industry analysis. So to set the competitive context, we have identified two rivals of Prada Group. So specifically the LVMH and the Hermès. So before we get into the numbers, a quick note on our two benchmarks. So LVMH is the market leader, the world's largest luxury conglomerate at 84.7 billion euros in revenue. It operates across more than 75 brands spanning fashion, spirits, jewelry, and cosmetics. Its competitive advantage is scale and portfolio diversification. Now, Hermès is a different kind of rival. It operates with one brand, extreme scarcity, and a pricing power that no competitor has been able to replicate. So at 15.2 billion euros, it is smaller than LVMH, but as we'll see, it is the most profitable luxury house in the world on a margin basis. While Prada Group sits at 5.4 billion euros, so the question we're gonna answer today is that what do these two rivals teach us and where should Prada go from here? Now let's start with the financial analysis. So we'll be presenting the rival financial analysis, specifically looking at how LVMH and Hermès have performed from 2020 to 2024 and what those numbers mean for Prada Group's competitive position. Now, let's delve into the horizontal analysis. So, the revenue numbers. LVMH grew from 44.7 billion euros in 2020 to 84.7 billion euros in 2024. So that's 90% growth, driven by its massive brand portfolio spreading risk across multiple markets. As we all know, LVMH holds Louis Vuitton, Dior, Givenchy, Bulgari, Moet, and Chandon. So that's just a few of the LV brands. So Hermès, on the other hand, grew even faster at 137%, going from 6.4 billion euros to 15.2 billion euros, proof that scarcity and exclusivity are a more powerful engine than scale. So Hermès focuses on ultra-premium goods, especially in its Birkin and Kelly bags, silk scarf, and leather accessories. So what this means for Prada? So it's keeping pace with the best in the industry and growth rate, but the real question isn't how fast they're growing, it's how much they're keeping. So the vertical analysis asks a different question. Of every euro Prada earns, how much does it actually keep? So looking at the gross margins, Prada has made a striking improvement, rising from 63% in 2020 to nearly 80% in 2024. So this is now above both LV and Hermès. So this reflects the successful shift away from wholesale toward direct retail, so where margins are significantly higher. But the operating margin tells an even more important story. So in 2020, Prada's operating margin was just 6.9%. By 2024, it reached 23.6%, effectively matching LV. So that is a 16 percentage point improvement in 4 years. However, Hermès is operating at 41.1%. That means for every euro Hermès earns, it keeps 41 cents after all costs. Prada keeps 24 cents. So in our view, the gap is large, but it is not permanent. So the Hermès model, no discounting, no wholesale, tight supply, owned retail, is like the blueprint. So Prada is already executing this kind of method. Now, let's look at the financial ratios. So think of this as a health check on each company. So first, liquidity, specifically the current ratio. This tells us if all short-term bills came due today, can the company pay them? So Prada's 1.52 times means that for every 1 euro it owes short-term, it has 1.52 euros ready to cover it. So that's fine, but Hermès sits at 2.45 times, meaning it has nearly 2.5 times what it owes. So Hermès essentially has a much bigger financial safety net. Next, ROE and ROA. So ROA of 9.8% for Prada means that for every 100 euro of assets the company owns, stores, inventory, equipment, it generates 9.80 euros in profit. So Hermès generates 19.90 euros from that same 100 euros. So Hermès is getting almost twice the return out of its assets. So Prada was at a loss in 2020, so reaching a 9.8% in just 4 years is a real achievement. Then debt to equity. So Prada 0.93 times means its debts are roughly equal to what it owns. So Hermès at 0.33 times means it owns far more than it owes. So it's nearly debt-free. The lower this number, the more financial freedom a company has. So in short, Prada is in a much healthier position than it was in 2020. So every ratio has improved. So the gap with Hermès is still there, but the trend is moving in the right direction. Oh, that's it. That's it for the financial analysis. Now let's look into the value chain analysis.
Now, moving forward with the value chain analysis and VRIO framework for Prada's main competitors in the market. Starting with LVMH, the company operates under a controlled, decentralized structure where its 75 respective brands function independently, while financial control remains centralized. This allows flexibility and innovation at the brand level while maintaining overall strategic direction. LVMH invests heavily in human resources through talent mobility, artisan training, and leadership programs, such as the Inside LVMH and Spring Graduate Program. It also leverages technology such as artificial intelligence, generative AI, omnichannel integration, and data analytics to enhance efficiency and customer experience. In its primary activities, LVMH focuses on selective vertical integration, strong craftsmanship in operations, controlled distribution, and experiential marketing using celebrities and digital platforms. Its services include product restoration and personalization to further strengthen customer loyalty. Under the VRIO framework, LVMH's strongest resource is its extensive brand portfolio, comprising around 75 luxury brands. This portfolio is valuable as it allows LVMH to capture multiple segments of the luxury market, and rare due to its unmatched scale and diversity compared to other luxury groups. It is also costly to imitate given the time, capital, and brand equity required to build or acquire such an extensive portfolio. It is well organized through the company's controlled decentralized structure. As a result, this resource provides a sustained competitive advantage, reinforcing LVMH's position as a market. Meanwhile, Hermès follows a strategy centered on exclusivity and control. It has high family ownership, having approximately 67% of company shares, allowing the company to prioritize long-term value creation and brand preservation rather than short-term financial performance. The company also integrates sustainability into its operations as well as prioritizes craftsmanship through in-house training and selective use of technology. Its value chain is highly controlled, with strong vertical integration, limited production, and selective distribution. Hermès intentionally maintains scarcity, as seen in its iconic products like the Birkin and Kelly bags, which are positioned as long-term investment assets rather than mere transactional purchases. This approach strengthens its premium positioning and enhances perceived value over time. In the VRIO analysis, Hermès's resources such as vertical integration, controlled distribution, and brand exclusivity are viable and difficult to imitate, but are not rare in the industry, resulting in temporary competitive advantages. However, their combined effect still ensures strong market positioning. In conclusion, LVMH and Hermès achieve success through different strategies. LVMH focuses on scale and brand diversification, while Hermès emphasizes scarcity and exclusivity. Both approaches effectively create value and sustain competitiveness in the luxury market.
Louis Vuitton's strategy is centered on scale and diversification. The company operates 70 brands, allowing it to dominate multiple luxury segments, from fashion and leather goods to cosmetics and wines. This creates a powerful ecosystem where each brand strengthens the overall portfolio. A key driver of its growth is aggressive acquisitions, such as Tiffany & Co., which expanded its presence in high-end jewelry and reinforced its global reach. At the same time, Louis Vuitton maintains vertical integration, meaning it controls production, marketing, and retail. This ensures consistent quality while protecting profit margins. The company also emphasizes distribution control, using its own stores and e-commerce platforms to maintain brand image and customer experience worldwide. Another important factor is its broad customer targeting. Louis Vuitton serves both aspirational buyers and ultra-wealthy clients, allowing it to generate high sales volume. Hermès follows a completely different strategy focused on exclusivity and craftsmanship. Unlike Louis Vuitton, it operates a single brand company, which allows it to maintain a strong and consistent identity. At the core of its strategy is a craftsmanship-first model, where products are handmade, often by a single artisan, ensuring exceptional quality and uniqueness. This is reinforced by intentional scarcity, where supply is deliberately limited. For example, iconic products like the Birkin bag are not easily available, creating strong demand and long waiting lists. Hermès also maintains strict distribution control, selling primarily through its own boutiques to preserve exclusivity and deliver a highly personalized customer experience. Its target market is very specific: ultra-high net worth individuals who values rarity over accessibility. Rather than expanding rapidly, Hermès prioritizes controlled growth, focusing on long-term brand values instead of short-term sales volume. This allows the company to maintain extremely high margins and prestige. Now let's proceed to critique the both companies. Both companies are industry leaders, but they face different risks. For Louis Vuitton, despite its large portfolio, it remains heavily dependent on its fashion and leather goods segment, contributing nearly half of its revenue. It is also more sensitive to economic downturns, with recent sales declines in key markets like China. Its large global network and over 6,000 stores may weaken exclusivity, while its acquisition-driven growth faces rising costs and operational complexity. In contrast, Hermès is fully dependent on a single brand, making it more vulnerable to a shift in perception. Its strategy of scarcity strengthens exclusivity but limits growth, as production cannot keep up with demand. Looking at digital strategy, Louis Vuitton's strong e-commerce presence increases reach but risks overexposure, making luxury feel less exclusive. In contrast, Hermès protects exclusivity with limited digital engagement, but this may reduce its appeal to younger consumers. In terms of pricing, Louis Vuitton's continuous price increases have led to signs of luxury fatigue, slowing demand. Meanwhile, Hermès' extremely high prices reinforce prestige but restrict its market to a very small elite segment. Both companies are also highly dependent on Asia, especially China, making them vulnerable to regional economic fluctuation. From a government perspective, Louis Vuitton faces concerns over leadership succession, while Hermès must ensure it stays relevant across generations. Overall, Louis Vuitton shows more performance volatility, while Hermès remains more stable, but its growth is constrained by limited supply.
We will now proceed to our industry analysis, where we examine the external environment shaping the global luxury fashion industry through Porter's 5 Forces and PESTLE Analysis. This section begins with our Porter's 5 Forces analysis of the global luxury goods industry. Our analysis indicates that the global luxury goods industry remains highly attractive for established players, yet extremely difficult for new entrants. Despite intense rivalry and rising buyer expectations, strong barriers to entry, premium margins, and brand loyalty continues to support profitability for incumbent firms. The strongest competitive pressures facing Prada is rivalry, substitutes, and rising buyer power. Luxury brands compete intensely for prestige and relevance, while consumers increasingly divert spending towards luxury experiences and retail markets. At the same time, buyers are becoming more selective, evaluating brands on sustainability, authenticity, and long-term value. Despite these pressures, industry structure continues to favor established incumbents. New entrants face major barriers due to the need for heritage, global legitimacy, and significant capital investment. Meanwhile, access to premium materials and skilled artisans remains limited, making supply chain control a growing strategic advance. Our strategic implication is that Prada must preserve exclusivity while remaining culturally relevant, strengthening control over its supply chain, expand its broader luxury ecosystem, and continue innovating to defend against intense rivalry. Beyond industry competition, we also assess the macro environment through PESTLE analysis. Politically and economically, the luxury industry faces rising geopolitical uncertainty, trade tensions, and stricter regulation. China's slowdown weakens a major growth engine, though resilient U.S. demand and ultra-high net worth consumer growth continue to support the sector. These trends increase the strategic importance of geographic diversification and customer mix. From a socio-cultural perspective, younger consumers are increasingly shaping luxury demand through preferences for authenticity, digital engagement, and sustainability. The rise of quiet luxury reinforces demand for heritage and craftsmanship, while resale growth of both validates desirability and diverts spending from primary sales. Technologically, digital transformation is accelerating through AI, omnichannel commerce, and authentication technologies. Legally, luxury firms face intensifying pressure from ESG disclosure mandates, labor complaint requirements, and inventory management restrictions. Environmentally, the industry faces increasing scrutiny over emissions, sustainability practices, and raw material sourcing. Climate change and circular economy mandates are forcing firms to rethink product design, sourcing, and long-term environmental strategy. The competitive landscape remains highly concentrated among powerful incumbents. LV leads in scale and diversification, Hermès in profitability, Chanel in brand equity, and Kering in fashion-forward luxury positioning. In conclusion, the luxury fashion industry remains structurally attractive but increasingly complex. Future leaders will be firms that combine strong brand equity with scale, agility, and cultural relevance while adapting effectively to technological, regulatory, and sustainable pressures.
To understand how business compete in the global luxury industry, we use a strategic growth map based on two dimensions. The x-axis represents business brand scope from single brand houses to multi-brand conglomerates. The y-axis represents exclusivity and scarcity strategy from high exclusivity targeting ultra-high net worth consumers to low exclusivity with broader market reach. Starting at the top left, we have Hermès. Hermès is a single-brand luxury house with extreme exclusivity and scarcity. It controls production tightly, limits supply, and targets ultra-high net worth consumers through iconic products like the Birkin and Kelly, placing it at the highest level of exclusivity. At the center is Prada. Prada follows a mid-level multi-brand system, balancing exclusivity with selective accessibility. Through brands like Prada and Miu Miu, it targets both core luxury consumers and younger fashion-driven segments, positioning it as a hybrid player between scarcity and scale. On the bottom right is LVMH. LVMH is the largest luxury conglomerate with around 75 brands across multiple categories. It serves both ultra-high net worth and aspirational consumers, resulting in lower exclusivity but very high scale and diversification. Aside from these three, other competitors are also plotted for context. Below Hermès is Chanel. It is also a single brand luxury house but with slightly lower exclusivity. While still highly prestigious, its broader product categories such as fashion, beauty, and jewelry make it less scarcity-driven than Hermès. And lastly, close to LVMH is Kering, a multi-brand group with a more fashion-focused portfolio. It is slightly more exclusive than LVMH due to stronger concentration in high-fashion brands. Overall, the map shows the future success of luxury firms depends on 6 key success factors. First, firms must balance between exclusivity with scalable growth as the market is increasingly shaped by K-shaped demand between ultra-high net worth and aspirational consumers. Second, strong brand equity and cultural relevance are essential, requiring continuous reinvention while preserving heritage. Third, advanced omnichannel and data-driven capabilities are critical as luxury increasingly relies on seamless physical and digital integration supported by AI and personalization. Fourth, end-to-end supply chain control and craftsmanship ensure product quality, traceability, and authenticity. Fifth, sustainability must be fully embedded into core strategy, not treated as marketing. Finally, firms must strengthen their ability to capture ultra-high net worth demand through stronger premium positioning and exclusivity. In evaluating firms, LVMH performs strongly in balancing scale and exclusivity, supported by its multi-brand portfolio and dual market reach. On the other hand, Hermès is the strongest in exclusivity, craftsmanship, and ultra-high net worth targeting, but is limited in scalability. Prada shows strong cultural relevance and craftsmanship, but remains hybrid player without dominance in either scale or extreme exclusivity. It performs moderately in digital capabilities and ultra-high net worth targeting compared to LVMH and Hermès. In conclusion, the luxury industry remains highly attractive but is increasingly polarized by K-shaped demand, strong entry barriers, and rising digital and sustainability pressures. Competition is defined by brand desirability, exclusivity, and cultural relevance, separating scale-driven conglomerates like LVMH from scarcity-led houses like Hermès. For Prada, It occupies a hybrid middle position, balancing exclusivity and accessibility, but its long-term success depends on either strengthening scale capabilities or elevating exclusivity to move beyond this strategic middle ground.